Market news now. Asian shares slid while the dollar was firm after U.S. consumer prices increased more than expected, bolstering the case for the Federal Reserve to keep the rates higher for longer. The increase in U.S. consumer prices for September contained a surprise surge in rental costs, and traders now see a stronger chance the Fed will end up delivering another hike this year. Meanwhile, Hong Kong and mainland Chinese shares extended losses after both consumer and producer prices came in below estimates, a sign that the country's economy still faces drags despite the government rolling out a series of support measures. To give us perspective on the markets, we are joined by Thato Mashego, who's a portfolio manager at Sanlam Private Wealth. Thato, thank you so much for your time. I mean, when you look back at the week that was, what were some of the key themes or perhaps even company news that dominated market activity?
Good afternoon, Anastasia. I think we have had quite an eventful week from a macroeconomic perspective. I would say that some of the highlights, of course, would be the ongoing conflict in Gaza as one, the rumors of Chinese stimulus as another, and as well as the IMF releasing its economic outlook, which came out yesterday. And I think all three of those do point towards one could say quite a volatile situation. Of course, with regards to Gaza, it's very difficult for the market to price in that sort of risk. It's not as obvious as, say, Russia and Ukraine, where we know from a grains perspective and wheat perspective, oil and gas, there's a huge supply shock there. Obviously, with that scenario, one doesn't know unless other actors get involved, and then, of course, it may have escalation risk. I'd say with regards to the IMF, obviously, they've reduced their GDP forecast for the world going into next year as well as this year relative to last year. And they've pointed out that growth is looking rather tepid. And so that obviously is not positive. What is positive, of course, is the rumors of the Chinese stimulus, and perhaps even more so with the release of CPI and PPI numbers, which you just mentioned. So the quantum of that and, of course, where that capital is directed to could have positive impacts, for instance, for commodity prices, base metals like iron ore, if we start seeing increased activity there. So those are some of the highlights, I would say.
Let's move things stateside for a bit and talk about U.S. inflation and your views on it. Do you think, from your perspective, given all the efforts that have been put out there by the Fed, that the Fed is actually on a sustainable path towards that 2% target?
Well, I think the market is fairly sanguine over the medium term. So if you look at 5-year break-even inflation, it's somewhere around 2.25 or 2.3%, which is not a huge amount away from the Fed's 2% target. However, I think that the Fed may be somewhat concerned with some of the very positive data which we've seen recently. As we all know these days, good news is bad news. Their own internal estimates for Q3 GDP, is running as high as 5.1% year on year. And if you add that to the very positive payrolls numbers last week, as well as the inflation yesterday with core CPI reaccelerating, this does point to an economy which is accelerating, which then obviously means added price pressures. And what does the Fed do about that? I would suggest that perhaps they would continue to keep rates steady, the reason being that we're seeing treasury yields rising. Some very weak auctions this week from the 10-year, and the 30-year points to weak demand. And we know that the US government obviously has to borrow quite a bit to meet their current deficits. And so elevated yields does go to some extent in terms of monetary tightening. So perhaps they don't have to tighten, even though the data suggests that they do, and they can kind of hold steady for now.
Let's talk about those bond yields and perhaps narrow in pre that CPI figure. Does your understanding of why yields were lower pre that figure give you any kind of understanding of why they were higher over the past 5 weeks, or are we still feeling our way here through the dark?
I think there is a lot of feeling the way through the dark, and people are positioning for various outcomes. So we did see a bit of risk on when we had comments from the Fed, or some dovish comments earlier in the week, suggesting that we kind of done with rate hiking, that the cycle has reached its peak. Of course, rates may still remain elevated for longer, but that was perhaps a bit of a risk-on signal, and we've seen quite a bit of flows into long-dated bonds recently, as well as long-dated treasury ETFs. And so people were kind of positioning for perhaps sometime next year a bit of rate cuts. And I think this was even elevated further with the conflicts that we saw in Gaza, adding to some potential instability, which could force the Fed to cut even sooner. So that perhaps was some of the reason why we had quite I think a dovish outlook for rates earlier in the week. And then with the print yesterday, I think that kind of changes the picture and suggests that there is actually no room in the short term for that scenario. And if anything, the market is now thinking there's perhaps even room for an additional hike from here. So it's a very, I guess, day by day, week by week situation we find ourselves in.
Just quickly, in 30 seconds, we've kicked off Q3 earnings season in the US. What's the one thing you're looking out for?
Well, I think the performance of the rate-sensitive sectors will be of paramount importance going forward, and this is everything from banking to speculative technology or spec tech, to property, even areas of consumer discretionary as well. So I think the underlying performance of all of these sectors, which are obviously quite sensitive to rate movements, whether from an affordability perspective of consumers, or even from just changing rate expectations going forward and how that impacts on earnings, I think will be quite critical as the market tries to position. Have we reached the peak? And we're seeing that in the numbers. So that's one thing I think would be of interest when we look at the earnings season going forward.
All right, Thato, let's leave it there. Thank you so much for your time. That is Thato Mashego, who's a portfolio manager at Sanlam Private Wealth. And just to mention, African Bank announcing that they have purchased 2 units from Sasfin for the value of 3.2 billion rand. And this is their third acquisition after having purchased both Grindrod and Ubank. And in this particular case, they are planning to scale up ahead of their planned IPO in 2025. That is it from me. We're going to take a quick break. When we come back, we'll have more for you. So stay tuned.